Most people are not broke because they made bad decisions. Most people are financially stuck because they never made a decision at all. They waited, they played it safe. They told themselves they would invest when the time is right, start that business when they had more money, or buy that property when the market settled down, and the years passed and nothing changed. That is not safety. That is a slow, quiet financial decline dressed up as caution. Today I want to talk about risk. Not the reckless kind. Not the gambler's kind. I want to talk about the kind of risk that actually builds wealth, the calculated, intentional, research-backed kind that separates people who grow financially from people who stay where they are. Because here is the truth that most people do not hear enough. Smart risk does not destroy financial security. Fear of risk does. Let us start with something fundamental. What actually is risk? Most people define it as the chance of losing something, and that is partially true. But the complete definition of risk includes the other side, the chance of gaining something. Every financial decision carries both. The question is never whether risk exists. The question is whether you understand the risk well enough to make it work in your favor. Think about what happens when someone avoids all financial risk for the next 20 years. They keep their savings in a traditional bank account, maybe a high-yield savings account if they feel adventurous. The interest rate there, even at its best, might give them 3 to 4% annually. Meanwhile, inflation in the United States has historically averaged around 3% per year. So in real terms, in actual purchasing power, that person is barely keeping up. Some years they fall behind. They feel safe because the number in their account is not going down, but the value of what that number can buy is quietly shrinking. That is not safety. That is a very slow, very polite loss. Now compare that to someone who, in their early 30s, begins investing $500 per month in a diversified index fund. Nothing fancy, no stock picking, no speculation. Just consistent, boring, disciplined investing in the broader market. Over 30 years, assuming a historical average annual return of around 7 to 8%, which the S&P 500 has historically provided over long periods, that person does not just preserve their money, they build it into something between $500,000 and $600,000. From $500 a month. That is not magic. That is compounding. That is patient, calculated risk. And someone will say, but what if the market drops? What if there is a crash? That is a fair question. And here is the honest answer. Yes, markets do drop. They dropped in 2008. They dropped in 2020. History shows that every significant market downturn has eventually recovered, and the people who stayed invested came out ahead. The people who panicked, sold, and moved everything to cash, they locked in their losses and missed the recovery. Smart risk includes knowing that short-term volatility is not the same as long-term failure. Those are two very different things. Now let us talk about what separates gambling from calculated risk. Because people often confuse the two, and that confusion keeps them from taking any financial steps at all. Gambling is putting money into an outcome you have no real information about, a slot machine, a hot stock tip from someone at a dinner party, a cryptocurrency because someone online said it would go up 10,000%. That is not risk management. That is hope dressed as strategy. Calculated risk looks completely different. It means you study the asset, you understand how it generates returns. You know what can go wrong, you have a plan for the downside, and you only commit what you can afford to lose in the worst case without destroying your financial foundation. That is a completely different mindset. One is emotional, one is analytical, and that distinction matters enormously. Warren Buffett has said for decades that risk comes from not knowing what you are doing. He is worth hundreds of billions of dollars, and he still describes his investment approach as buying businesses he understands, at prices that make sense, and holding them for the long term. He does not time the market. He does not react to headlines. He evaluates businesses based on fundamentals, earnings, management, competitive position, and then he waits. That patience, that discipline, that commitment to understanding before investing, that is smart risk. Not fearlessness, informed confidence. When Jeff Bezos left a well-paying, stable job on Wall Street to start Amazon in 1994, the business had no guaranteed success. E-commerce was not proven at that scale. He was walking away from financial security, but he did not just leap blindly. He analyzed the growth of internet usage. He identified a product category, books, that worked well for online sales. He built a plan, started small, and scaled methodically. He called it a regret minimization framework. He asked himself which choice he would regret more when he was 80 years old, trying and failing or never trying at all. That is not recklessness. That is intentional risk-taking with a clear-eyed view of the downside and the upside. Elon Musk, when he sold PayPal, received around $180 million. He could have retired comfortably at 30. Instead, he put nearly all of it into SpaceX and Tesla simultaneously, two companies in industries that were brutally difficult and capital-intensive. Both nearly collapsed. But he had not gambled randomly. He had done years of research into physics, engineering, and market potential. He understood the industries deeply. The risk was enormous, but it was not uninformed. And even people who find his personality polarizing cannot deny that the outcomes reshaped multiple industries. Now let us bring this closer to the everyday world. Because not everyone is starting a tech company or managing a billion-dollar portfolio. Most people are just trying to build a better financial life with the resources they have, and smart risk works at every scale. Consider someone with $5,000 saved and a skill. Maybe they know graphic design, bookkeeping, home repair, tutoring, or digital marketing. Instead of leaving that $5,000 in a savings account, earning almost nothing, they invest it into building a small side business. They spend $2,000 on a professional website, basic tools, and some initial marketing. They spend the remaining $3,000 as a safety buffer. They charge clients. They start slow. They make mistakes, adjust, and improve. Within 12 to 18 months, that side business is generating an extra $1,500 to $2,000 per month in income. That is an additional $18,000 to $24,000 per year from a $5,000 starting point. Not a guarantee. Not every attempt succeeds. But the risk was bounded, it was planned, and it was based on a real skill they already had. That is smart risk. Now let us walk through a real estate example, because property investment is one area where many people feel intimidated, but where the numbers often tell a compelling story when examined clearly. Say someone in a mid-sized American city purchases a single-family home for around $300,000. They put 15 to 20% down, roughly $45,000 to $60,000, and take out a mortgage on the rest. Their monthly mortgage payment, including property taxes and insurance, comes to approximately $1,800 to $2,000 per month. They rent that property out for $2,200 per month, which is a realistic figure in many American markets for that price range. After accounting for maintenance, occasional vacancies, and property management, if needed, let us call that another $200 to $300 per month. On average, they are clearing somewhere between $100 and $400 per month in net cash flow. That alone is modest. But here is what people miss. Simultaneously, the mortgage is being paid down each month by the tenant. And if the property appreciates at even 3 to 4% annually over 10 years, which is historically conservative for U.S. real estate, that $300,000 property could be worth $400,000 to $450,000 in a decade. The equity built through appreciation and mortgage paydown can be substantial. That is how patient real estate investors build wealth, not through overnight flips, but through time, research, and responsible leverage. And yes, things can go wrong. Tenants can default. Roofs need replacing. Markets do not always appreciate. That is why smart real estate investors stress test their numbers, maintain cash reserves, and never overextend themselves. They account for the bad scenarios. That is exactly what separates calculated risk from recklessness. Now, why do so many people avoid all of this? The psychology here is important. Research in behavioral economics shows that humans feel the pain of a loss roughly twice as intensely as they feel the pleasure of an equivalent gain. Losing $500 feels much worse than winning $500 feels good. This is called loss aversion, and it is deeply wired into us. It made sense for survival thousands of years ago. Be cautious, avoid danger. But in the modern financial world, this instinct works against us. It tells us to avoid any possibility of loss, even when the probability of gain is significantly higher and the potential upside is much larger. Smart investors are aware of this bias. They do not let it drive decisions. They acknowledge the fear, examine the actual numbers, assess the real probability of different outcomes, and then act based on logic and strategy rather than emotion. That is not something you are born with. That is something you practice. Comfort zones are financially expensive. That sounds harsh, but it is accurate. Every year someone delays starting an investment account is a year of compounding they never get back. Every year someone avoids learning about real estate or starting a side income is another year of depending entirely on a single paycheck. The comfort zone feels safe. It is familiar, but familiar is not the same as secure. And comfortable is not the same as financially free. The people who build real financial resilience, not just the ultra-wealthy, but everyday people who retire comfortably, who have options, who do not live paycheck to paycheck, almost universally share one trait. They took calculated risks at key moments in their lives. They invested when it felt uncertain. They started that business when they could not guarantee success. They bought that property even though the timing was not perfect, and they did it with research, with planning, and with a clear understanding of what they could handle if things did not go as expected. If risk is always bad, why do successful investors consistently take it? Because they understand something most people do not, that the biggest risk of all is doing nothing. Inflation erodes idle money. Wages alone rarely build wealth. Opportunities have windows, and time once passed never returns. This is not about being reckless. It is not about betting everything on a single idea. It is about becoming someone who understands financial instruments, who builds knowledge before committing capital, who starts small and scales deliberately, and who accepts that uncertainty is a permanent feature of any worthwhile financial journey. You manage uncertainty. You do not eliminate it by standing still, because standing still has its own cost. It is just quieter. Smart risk is not for a specific type of person. It is not reserved for people with MBA degrees or investment banking backgrounds. It is for anyone willing to educate themselves, think long-term, and make decisions based on evidence rather than fear. The information is available. The tools are accessible. What changes the outcome is the decision to engage with risk intelligently rather than avoid it entirely. Fear keeps the money in the savings account. Knowledge puts it to work. Patience watches it grow. The question is not whether you can afford to take smart risks. The question is whether you can afford not to.